Well, for more on some of those moves, we're joined live by Michael Wayne from KOSEC Kodari Securities in our Sydney CBD studio. Michael, welcome to the program. Thanks for joining us. Masters certainly continuing to weigh on Woolworths, as we mentioned there, those losses jumping 33% last year. Woolworths, though, pretty confident in the long-term viability of Masters. In your opinion, should they just be cutting their losses and focusing on those supermarket assets?
Look, I mean, this Masters story has been ongoing for a while now, but I don't think getting rid of Masters is going to be a silver bullet for Woolworths. I mean, they're facing a lot of competitive pressure from the international entrants, such as Aldi, such as Costco, and they're losing market share in their core asset or their core business, which is the groceries business. So we've seen overseas with companies like Tesco and Carrefour in Europe, test cases if you like, and they've significantly lost market share and lost profitability overseas. So it's no surprise to see a similar sort of thing start to unfold with Woolworths. I've used this analogy before. Woolworths might stock 10 different brands of tomato sauce, which is good for optionality and customer choice, whereas Aldi might only stock 2 different brands of tomato sauce. But the problem is it puts enormous pressure on Woolworths' margins going forward. So at the moment, look, we don't think Woolworths is necessarily going to go bankrupt or anything like that. We'll just rather focus our attention elsewhere because Woolworths' margins are significantly coming under pressure. In the most recent report, their revenues were up, but their profits were flat. So that indicates margin pressure there. And there's no silver bullet with this Masters situation. Their main issue at the moment is the foreign competition coming in from Aldi and from Costco.
Okay, so we speak about potentially avoiding Woolworths there, but I guess with that increasing competition across the sector, would you be investing in any of the supermarkets at the moment, or would you just be staying clear of the whole sector?
Sorry, I just cut out. We had an ambulance that went past.
That was extremely loud. I just said with the increasing competition across the sector, would you be looking at investing in any of those supermarkets? I mean, you mentioned there the pressure on Woolworths, but would you invest in any of the large supermarkets or sort of stay clear of the sector?
I mean, we'll be steering probably clear of the entire sector. People often quote Wesfarmers as being more of a conglomerate, but even they still rely 50% of their earnings come from Coles going forward. And then obviously Metcash is probably the worst position there. They're right at the bottom, if you like, and they're having their margins squeezed the most. They're having their market share eaten up the most by Aldi. So at the moment, I would just be steering clear of that sector altogether. There's not a lot of clarity going forward. And as I mentioned earlier, there's the overseas examples of how these businesses have really struggled to take into account these new entrants coming into the market.
So, Michael, we've seen there that the concern that with, Aldi increasing its market share, squeezing out the independent players such as Metcash, as you say, could that be snapped up by one of the big players? I mean, what are the chances of, say, consolidation across the sector?
In terms of acquisition, I'm pretty sure Aldi's a privately owned business coming in from Germany, I think it is. So I don't think they're a very large business in their own right. So I don't think there's any sort of room for any acquisitions and things like that. Woolworths and Coles in this country pretty much have all the primary locations snapped up. It's just that people are being lured into the discounts of Aldi, or they're being lured online to either through Coles' platform. So I did also read that although Woolworths has increased their online presence, they've been selling more online for a lower price. So that's one avenue they could go down, maybe to sort of try and dominate that online space. But at the moment, I don't see any room for any consolidation or acquisitions or anything like that, because I'm not sure whether Woolworths want the quality of assets that IGA have or Metcash have. I just don't think it would make sense for them.
Yeah, good point you make there. Moving across now from the supermarkets, I guess I wanted to ask you about where you would be investing your money. I mean, with so much volatility on markets at the moment, everyone questioning where they are headed. I guess also presenting opportunities, though. So what would be your top pick at the moment? Look,
our top pick at the moment would probably be TPG Telecom. It hit an all-time high just a couple of days ago, despite the market selling off from its from its yearly highs earlier in the year. The fact is, something like a TPG Telecom is one that we've been recommending. Anyone who's followed Michael Kodari on Your Money, Your Call or KOSEC for a while would know that it's our favourite pick for a very long time. It's been taking market share away from Telstra, has a much lower cost base than Telstra, and it's been using its enormous amount of free cash flow generation to fund this expansion. We've seen them acquire AAPT. They incorporated that into their business model very successfully. They've now gone out, they've acquired iiNet, so they've got 1.7 million broadband subscribers, so they can go ahead now and cross-sell products like their fibre to the basement product, which is going to compete with the NBN. So the growth prospects are very much still on the table, despite their strong performance in recent years. I mean, people often quote Telstra have a much higher dividend yield than TPG, and that's right, but the fact is Telstra hasn't grown its earnings per share in 10 years. Their dividend per share is basically the same as it was 10 years ago. And if you took today's dividend per share on TPG and divided it by the share price a couple of years ago, your effective dividend yield on TPG would be equally as good as Telstra's, if not better. So I suppose it's just about identifying these businesses early on, and therefore your overall shareholder return, dividends and capital growth can be quite significant. So TPG is probably our preferred pick at the moment.
What about on the other side? I mean, is there anything you'd be selling out of or avoiding?
Yeah, look, we're very cautious on something like a Cabcharge. Cabcharge had a monopoly on that taxi payment system for a very long time. But the fact is they're also suffering from structural decline as well. There's international entrants such as Uber coming into the market. There's GoCatch as well. We've had also the state governments from New South Wales, from Victoria, from Western Australia. They've cut the credit card surcharge that Cabcharge can charge their customers. So they're a business whose earnings are coming under pressure, their revenues are coming under pressure. We only saw just a couple of days ago, GoCatch has teamed up with Mint, one of the payment services companies listed on the ASX. So they're going to continue to come under significant pressure and have their margins and their market share significantly eroded. I also know that I think Uber has been focusing on that corporate market, which has traditionally been the domain of Cabcharge. So as these international online technologies really start to eat into Cabcharge, I just don't see how their earnings can hold up, and if their earnings are under pressure, then their share price will probably fall away as well. So we've got to sell on Cabcharge at the moment.
And finally, Michael, just wanted to ask you about the market in general. I mean, today really bouncing around. It's just dipping into negative territory at the moment. I guess investors sitting on the sidelines somewhat ahead of that Fed decision next week. What are the chances, though, that we can finish in the black today?
Look, the markets have been very volatile. It's very hard to say when it all comes to an end. It's not like you can pick a point out in the future or even a certain event in the future and say that from this point on everything will be fine and normality will resume. What I do know is that the size of moves that we've been seeing, not only intraday but also from day to day, they're abnormal. So what we'll be looking for is the volatility to settle down. We'll look to see some normality and some normal trading bands re-emerge, and then we'll make our decision to get back involved once we see that volatility settle down a bit.
Fantastic, Michael. Really appreciate your time. Thank you for joining us.
No, not a problem. Thanks for having me.